Welcome to part 3 of our 4-part series on behavioral science and investing psychology. Today we're going to talk about some other common investor mistakes, 4 of them in particular, that are near and dear to my heart, simply because they're probably the biggest mistakes that most investors make. Mistake number 3A, we think too much in linear terms. It's very often that investors will go to their advisor and say, I want 10% a year. Unfortunately, 10% a year does not happen in reality. In the last 100 years, a 10% return has only occurred 8 times in the last 100 years. It's more important for investors to take the scope of markets over time and pay attention to the fact that they may have a range of returns based on their asset mix. So for example, if you have 100% invested in equities, you should have an expected return in any one year of plus or minus 20%. The fewer equities that you have, then of course the expected returns are going to be lower. Try and get away or avoid the idea of trying to make 6, 7, 8% every single year. It just doesn't happen. It's not reality. Investor mistake 3B, stop trading too much. It's more important for investors to realize that they're investing in businesses, not trading stock prices. An investor invests. A speculator or a gambler trades too much. What's important to remember is that if you've made 20% on an individual stock investment, you really haven't made 20% because after tax, commissions, and bid-offer spreads, you've only made 14%. That kind of drawdown or negative return is going to hurt your trading activities over time, whereby you won't make any money in the long run. Even if you're Warren Buffett and you're right 6 times out of 10, you'll end up making nothing. Investor mistake 3C, avoid the noise. Stop listening to the headlines, stop reacting to the headlines, and start investing based on what your intentions or your goals are of companies that are not in the news or on the headlines, that are under the wire. It's very important that people not react to the noise. Usually they'll get caught up in an investment where momentum investors and retail investors will be buying like crazy, just like the commodities today, for the fear that you have to avoid the last man standing. If you're the last man standing and can't get out of your position, you've only got an entailed loss ultimately coming down at you. Investor mistake 3D, avoid the big loss. It's too often that investors want to make a lot of money in a short time frame, but what they have to remember and understand is it's capital preservation on the downside that helps them make money in the long run. Reduce your bet sizes, diversify, make sure that you don't have exposure to any one stock in your portfolio, and that'll help you avoid the big loss. It means you're not going to make 30, 40, 50% in any one year on the upside, but it's going to preserve your capital and allow you to retire. So stay tuned for part 4 of our 4-part series. It's going to be on risk, and the one thing that most investors do not understand is risk and how to manage it in their portfolio.
You